Your grandfather, I think, Sheikh Hussein Ali Yusuf Ali, started this company back in 1948 as Hema's Drugs.
Hema's Drugs Limited, yes, that's right.
So if you just briefly tell us the history behind this company.
Yeah, so as you say, we were founded in 1948, and then like most other entrepreneurial organizations, the company entered various fields of business. He had 4 sons, so each one of them joined the businesses, as time went on. And I can't count the number of businesses we've been in and out of. Over time, I think we settled on some areas where, obviously the company found to be its strengths. And having gone through the 70s when the closed economy stage,
right,
and then things opened up and more opportunity came. And then me and there are 4 of us in our generation in the business today, so we're the 3rd generation. And we joined the business in the late 70s, early 80s. And around early 90s, the company structured itself into a sort of a holding company and specific business enterprises. And as you know, 2003 we listed the company, and here we are today. So we get listed under the diversified as a diversified stock. Essentially, but I think to better describe what we do, on one hand we are involved in healthcare and personal care or consumer products. And on the other hand, we are involved in hospitality and travel.
Leisure, yeah.
And of course, we're involved also in areas like power and a few other areas which we club under a 3rd basket, as it were.
Right. So a long way from where it started in 1948.
That's right, long way.
And yes. So what made you all transit from this intensely closely held group into a publicly listed company?
Yeah, so at the time, in the early 2000 or so it was, when the 2nd generation of the family was sort of passing the reins on to us, as we said, the 3rd generation. I mean, we got together and we asked ourselves, where do we want to take this company in the next 10 or 20 years? And one of the things that we said to ourselves is that we would like to stay together and not get into the trap that a lot of families get, where you sort of bifurcate in order, at some point in the family's history. So we said, yeah, we want to stay together, but obviously we want to build the pie, and also we want to have economic freedom at some point on for all of us. So that was one. The other part, of course, is we needed to raise money for our power project that we were getting into. So these were the drivers of us going public.
So did you also try to consider any other forms of capital prior to your decision to listing?
At that time, not really. I don't think the market was as sophisticated as it is now. So no, it was really the listing route.
Right. So this is a good story, because one side, of course, you wanted to raise capital, which is mostly why most people go and list their company. But secondly, you brought in an interesting aspect where, as a family company, you believe that you may have better structure and a longer, a future within and holding the company, but yet not losing control of it, because losing control was not a feature that you had to worry about, because most family companies, of course, the first thing they say is, they don't want to do this because somebody will come and take over the company.
Yeah, sure.
Right. So you had no fears of such. How did you all figure out that you will overcome that challenge?
Well, I mean, first of all, it was pretty simple. At that time, we were giving out 20% of our stock. So, there was really no chance of anybody coming and taking over.
Right.
But I think the more important thing is that I think at that time and over these 10 or so years that we've been public, the family unity is a very important thing, and we have conversations going within the family which sort of says that this is something which we will nurture and pass on to future generations to come.
So this kind of allows you to also to keep the company identity. You will remain on the board, is it? And how would this transition happen?
You mean the transition
from say
going forward?
Family held, yes, going forward. Family held to a family, the orientation, kind of a brand image.
Yeah, no, clearly, I mean, from the time we were listed, at the time we listed in 2003, we were, executives in the company. We were directors on the boards of the subsidiary companies and the main company as well. And also we were shareholders. And oftentimes it was the shareholder hat that you wear least often.
Right.
And most of the time you're thinking as an executive. So we said one of the things we wanted to do was over time to draw a line between management and ownership.
Right.
And
separation
of management and so I guess over these 10 years, and it's taken that long, so we've made some progress in that area, and we was mostly getting out of management now, and we'll be focusing on ownership. Of course, we continue to play a part in the key strategic decisions of the company, and also very much in the values and the identity of the company as it goes forward, which is very important to us and to any family company.
So initially, when you were the pre-IPO days, or maybe say 1 or 2 years before the IPO, did you start structuring the company to kind of guide you along for the post-IPO stage? Did you start hiring professionals, or start letting go, giving different kinds of structure to the company?
Yes, we did, but we were fortunate in that the type of businesses that we were in, like the FMCG business, like the healthcare business, already required you to compete with multinationals and other companies. So in terms of structuring processes and structuring systems and all that, and also getting good talent on board, we had achieved some degree of I would like to think that we were a professional company even before we went we listed. So from that point of view, and also we had a good financial governance system in place. So the transition wasn't that difficult for us. But yes, there are some things that we did have to do. We started having to get our affairs in order, and things like the board, getting people on the board, and other things. But by and large, it wasn't too painful a journey.
What are the kind of options that are available for a privately held company to get listed, and what are the options available for funding? What kind of capital do you all actually raise?
Initially, private companies would need to be converted into public limited companies before they can be taken to the market. But the three methods we have in Sri Lanka of listing companies are what's called an offer for subscription, which is where a company would issue new shares to the public, and the money that is raised by issuing those shares comes into the company, which it can use for expanding its activities or investment or whatever.
IPO.
Yeah, well, that is also an IPO. Also, you can have an IPO through an offer for subscription, which is where instead of raising new money into the company, the existing shareholders of the company will sell some of their shares to the public through a public issue. So that is also an IPO. That money, of course, won't come into the company. It will go to the shareholders who are selling, and you can have
a kind of where you will kind of give to a private.
No, it is also an IPO. So, for example, if you take the Sri Lanka Telecom IPO, that was a offer for sale, because what happened was that the government sold down part of its shareholding in the IPO, so that money didn't go into the company, if I'm correct. And you can also
Some
have
people divested.
Yes, correct.
That's
It's a
part of
divestment.
IPO. Okay, fine.
So also you can have a combination of offer for subscription and offer for sale, where you raise some new capital into the company and the existing shareholders divest part of their stake as well. And also in Sri Lanka we have what's called listing through introduction, which is you don't raise any new money into the company and no one
But that is provided you have either a parent company or your company already a part of
no, that
listed?
is provided that the company has what's called a tradable free float of 10% for listing on the second board, or 25% for listing on the main
So
board.
we'll start with how does the process start? Does a company come and tell you we want to get listed, or we want to raise capital, or it's a combination of one of those two?
I think it's a combination of both. Sometimes we have seen people coming specifically asking for listings, and some instances we have seen people asking to come and raise money. So then we would actually look at what options are available for raising money, whether it's debt or equity, and then we would accordingly advise them. So if it is equity, then we would look at to see whether the company is prepared or ready to go for public, and then if it is so, yes, then we would take on the assignment to list. But otherwise, then we would look at other options available, say like private equity or pre-IPO placements, where it might not be the correct time for a listing, but might have to go through a private placement prior to that to see that the company raises the required money and then
Places itself
so that they can actually go for a listing subsequently.
Right. The private placement or angel investors or whatever you can call them is the first step of finding capital.
Yeah.
But let's say we have done all that and now you're at the stage of wanting to get listed. So how does that work out?
Well, in terms of, I guess, when you start off, it's always an angel investor that you're looking at. But as you mature, the options out there for you are private equity and an IPO. When it comes to choosing between the two, it's really one more of an emotional readiness as well to actually go out into the market. People do have this concern that they would be divulging too much information maybe too soon, which is not really the case, but it takes time for people to get comfortable around actual disclosures, investors questioning their moves. So in that case, it's good to have one professional investor like a private equity investor on board, because that actually brings the company into line, gets systems and processes in place. A lot of times, especially in family run businesses or owner driven businesses, you don't view the owner as separate from the company. They are viewed as one and the same. Whereas when you do have another third-party investor on board, you are forced to think of the company as a separate entity altogether. You are thinking what's best for the company, how do you structure the company, the systems in place. You might have to report to the third-party investor as to how you are doing. So the private equity investor coming on board actually prepares the company for them. Now, some companies are already streamlined enough to have actually bypassed that stage, because some companies are run that way where there's professional management on board and information systems are there, in which case you can go directly into an IPO. So it's not really as to how many years you've been in existence, but at what stage of that cycle you are in to be emotionally ready to actually go out and go to the public.
So what kind of triggered your decision, I think, from 95 to 2011 when you are listed? What triggered the listing decision?
Well, as we were growing in the business, we were doing quite well. In fact, in 2002, we became the market leader in the industry after 6 years of operations. And we were doing extremely well at that time. And with the potential of business that was available at that time, there was a need to improve our capital base. And also, the regulators, the central bank also, since during our short period, the business process that we had, they also made a request for us to list the company in the stock exchange.
Right. So basically, like most companies, of course, have a funding requirement or they want a valuation requirement, but People's Leasing being a part of People's Bank and plus, I guess, a leasing company, had also other requirements that they went through when they listed, is it?
True, but even People's Bank, although we had their single borrow limits, we could not borrow anything against a single borrow.
Right.
So we had to look for other avenues,
I see.
which we resorted to other banks also.
Right.
One other concern was during, if I may add something, one other concern was when the company was growing, the gearing was becoming an issue, because you would remember at that time the companies were growing at a very high percentage.
That's right.
So this was one good avenue for the company to go and broad base the capital of the company, so the balance sheet would be strengthened. So there is one other reason why we went for the IPO.
So how much did you raise from the public in your IPO?
We raised 7.2 billion at that time, which was the largest in the post-oil era.
That's right. So how, what is the experience of this IPO process? How did you find it? Challenging? Was it easy? Was it a cakewalk? How did that happen?
Nothing was a cakewalk.
Yes.
It was, we had our share of challenges. It was, I should say, a very interesting process, and a lot of new things that we learned also in the process. There were a lot of challenges because if you might see, we have a state ownership. So in a way we were coming for an IPO for a state institution. So those challenges were there. And on top of that, this was going to be one of the largest IPOs. So we actually had our concerns whether the market could absorb it. So those concerns were also there.
Okay.
And on top of that, all the regulatory aspects that we have to meet. But we're happy to say we did it very successfully.
Right. Anything, Inuka? Yes.
Yeah, from the starting the process, actually, though there were many challenges, we didn't take that long actually to complete the process, because we were able to, because we had studied this and with the advice of our financial and legal advisors, we were more or less able to complete this whole entire process within about 5 months, 4 to 5 months period.
From the decision that you all took to go list, to list.
Correct.
To list was
To
5 months.
complete
That's
and
very short.
to come on the
The timing was perfect.
Yes.
There was a market appetite,
Right.
and the economic growth was there, and the market was bullish.
Right.
So all that we thought we will try to capitalize.
Perfect timing and perfect execution.
Yes.
Yes. Yeah, because some of the companies, of course, all of the companies that we had here on board here as guests were privately held and private companies. Some were family companies going, getting listed, and this is the first instance where we have, more or less a government, fully owned government subsidiary.
Exactly.
So how much of the percentage of the company was given to the public?
We gave it 25% to public,
So
because we wanted to be in the main board.
Right.
So that was the minimum requirement.
Right.
So we went for that.
Raigan Viable Saltons. What's that company about?
Actually, if I go back to the history to 1997, we started Raigam in 1997 with 8 employees as a small company to aiming to manufacture manufacture and distribute food items in Sri Lanka.
Right.
And we started with soya. And when we went by, we wanted to enhance our portfolio, the product range, and where we started packing and distributing salt, mainly table salt. When we distributed table salt, 100% of them were imported table salt from India, and we thought why we are importing salt.
We have so much salt all around us.
We have so much salt. The country right around the sea, right around the country is surrounded by the sea. This is an island.
Yes.
There are many arid areas where it is suitable to salt manufacturing. Why we keep importing salt to Sri Lanka, mainly table salt. 100% of the usage of table salt in Sri Lanka were imported stuff, and we thought of going for a refinery, aiming for a refinery. In 2005 we have started Raigam Viable Salt, and we incorporated as a private limited company, and we bought a plot of land in Putlam, Palavi, and started a refinery. Now we had to go on a many hurdles because of raising capital that time due to couple of reasons. The main reason was the technology was new to Sri Lanka. That salt industry, if I'm not making a mistake, it's one of the oldest industry existing in Sri Lanka, but nobody has taken any initiatives to start a salt refinery. The refining salt.
Is it because it's capital intensive, or what's the block?
I don't understand the reason,
How come
but
nobody thought
the
of this
technology is
first?
technology is a bit of the new technology. It's Krebs Selex technology coming from Switzerland, but India they mainly use this technology for salt refining, but due to some reason or other nobody has started. Main reason maybe the salt industry, 90% of the salt industry was in the hands of the public sector. So the public sector, when they go to start businesses, they kind of there are hurdles here and there. Then however there nobody has started, and we wanted to start this, and we sent our people to India for training, and we identified a couple of manufacturers who manufacture machinery for salt refining, and wanted to take a bank loan and to start industry, and they were a bit hesitated due to the fact that it's the new industry in one hand, and the other one is mainly it's a corrosive material. If the industry will
specific risk there was.
Industry specific risk, and also nobody has started it, then they couldn't really predict forecasted whether the industry will thrive. And however we started with difficulties, and 2006 we started the operation of refinery.
So by the time you all actually decided to go public and seek funds from the public as opposed to going banks, what made you all decide on the public listing? Why didn't you go to the bank again, for example?
So if I add something to the views stated by Ravi, now in this industry at that time we wanted salt, raw material. For that you have to develop saltants. That is long-term investment. So if you not like retail or wholesale, you start the business today and from tomorrow you get the turnover, you have to wait some time. You have to get the construction done and the forming the solvent, and to get the good quality product, it takes time. So you need long-term capital, one hand. On the other hand, since it was a new industry, the banks were not prepared to give enough funds. Of course, they were positive in giving the loans for some other businesses, but this is new industry. End of the day, the collateral that we give the machinery are only usable in this industry. You can't sell it to another person.
Right.
And again, there was a fear with the people, because at that time, when you import salt from India to Sri Lanka, there was no protection. Sometimes the cost may be less than the local production. So nobody wanted to invest money in this area. So we are the people who first went into this industry, taking the risk, and invested money in the construction of saltants. So in that time we wanted the long-term capital.
So that is how you ended up with the Dirisavia board, because of what are the reasons that you didn't go on the main board, for example?
No, if I take in 2009 when we decided to go public, we were qualified enough to go on both boards. Maybe the minimum requirement 500 million stated capital, and the profit requirement and the positive net asset, all were there. But we wanted to start this small. Now this we started everything new. So this one also we thought of, okay, let's go to Dirisavia board first, and in the future we will look at that, how it happened. And this is actually an experience. We wanted to see the impact on going listing, and also we believe that the compliance requirement also minimum in the
Much to be gleaned from these individuals who have shared their expert opinions with us on Going Public. While thanking everyone who has been a part of the show so far, I hope all of you will join us next week as well for the final episode of Going Public. Until then, this is Amaya wishing you a good night. Take care until we meet again.